Hello everyone and welcome to another edition of Emkay Macro and Market Moves. Today we have with us Mr. Seshadri Sen, who is the Head of Research and Strategist at the Institutional Equities Desk at Emkay Global. So very good morning to you, sir. Great to have you. Before we get into sort of more specific topics to discuss, I think it will be great if we can have a bit of context setting in terms of what do you see the market outlook for the CY24, for calendar year 2024, given the fact that the geopolitical sort of tensions that we saw last year have continued into this year, given how valuations have moved, especially in, say, the first month or so of this year. And also, of course, the forecast for rates for the rest of the year has also been very volatile, right? So taking all of this into consideration, what is your broad sort of market outlook for the year?
So thanks. We are expecting a very quietish year for the markets with around low single digits, 10-11% returns for the broader Nifty. The valuations, we are slightly above long-term mean in terms of 1 year forward PE. We expect that to moderate to about the mean levels by the end of the year, because by the time we end the year, we are looking 1 year further ahead, and earnings growth will remain robust, but it will, there will be some challenges, especially on commodities, etc. So some moderation in valuation will take us to a 10-11% returns on the Nifty. We, however, there are two qualifiers to that. One is that the returns, as they always are, will not be linear, and we expect that in the second and third quarter of the calendar year, the returns to be bunched. The first quarter, as we are seeing, we are halfway through the quarter, we're getting a lot of sideways movement with volatility. That will continue because the market in the run-up in the November-December period had gone up to slightly frothy periods, and some of that froth is running off. Once we get into the second quarter, there's more visibility on FY25 earnings. There's more visibility on the political front. There will be, the rally will resume. And it will intensify as we go through, because I think in the third quarter, in the July-September quarter, there are two major events. The budget of the new government, which we expect to take reforms even further, and there will be some big ideas. The market will get some sense of what the next 5 years hold. There will be, in our view, the rate cut, both in the US and India, will come through at that time. So the returns will be concentrated between April and September, giving about a 10% return for the Nifty. We also expect that the past 2-3 year trend of small and mid caps outperforming the Nifty will continue for 2 or 3 reasons. One is that the earnings growth is more exciting there. There are more ideas there. More importantly, this growth cycle in India is more a manufacturing driven growth cycle rather than a services driven growth cycle. You will find that in the Nifty, the concentration of services, just financials and IT itself, are more than 50%. Even in the manufacturing side, consumers, etc., are more asset-light businesses than asset-heavy businesses. We think that this is a different cycle from the pre-COVID decade, and therefore SMIDs will outperform the large caps. So to recap, we expect about a 10% return for the Nifty, concentrated in the middle of the year, with small and mid caps outperforming the Nifty yet again.
Okay, thank you for that, Seshadri. So just to go back in terms of the context that I set earlier, I spoke about geopolitical risks last year sort of carrying forward into this year as well, and of course they've actually sort of been exacerbated, especially say since December, with the sort of disruption in shipping that we've seen in the Red Sea, which is still continuing. The conflict in Gaza shows no sign of sort of being sort of seeing any resolution, and Ukraine and Russia is also sort of carrying on as it was earlier as well. So, regard to these sort of geopolitical factors, do you see any resolution happening this year at all? And if at all, we see resolution in one or more spheres, what impact that could have on markets?
Not a geopolitical expert, but let me first enunciate what I think will happen. Russia Ukraine is a long, meaning either it had to be resolved in the first 6 months. Now that it's going on, it is a long process because it ebbs and flows. Every time you hear one side saying we are near victory and then the other side comes back, there are two powerful lobbies working both sides, and I don't see an easy resolution of that conflict. Israel, the Middle East conflict will also, I fear, be an extended conflict. We were, about a couple of weeks ago, we were talking about a ceasefire. Now that seems to be completely off the table. Once again, it will ebb and flow in terms of how it goes on. I think what is complicating the resolution of these conflicts is the upcoming US presidential election, because the way that goes will define how both these conflicts go, right? Each of the two leading presidential candidates have vastly differing views on how that conflict, US should approach that conflict. So until the US elections are done, you will not get a result. But it will be sort of both sides would mark time and then we will. Having said that, I don't think it's of great relevance to the market anymore. Ukraine is now a few years old and not impacting markets anymore. Middle East, the fear was that it would send oil prices into an up spiral, but I think both OPEC production and non-OPEC production has responded to ensure that that does not happen. Once again, in a US presidential year, US is invested to ensure that oil prices don't go out of whack. We've seen the winter gone by, so from here on to expect an oil price shock. So the relevance of these geopolitical conflicts to the market, especially the Indian market, are starting to ebb. The Red Sea is a new complication. It has a mild negative impact. We have to watch for individual companies which depend either on importing their raw materials or exporting their finished goods. We've heard a few companies during the earnings season mention that they've missed some production targets because of the choking of supply. But very frankly, it will adjust itself, right? People will adjust to the longer lead time. This is not of the scale of the post-COVID supply disruption, so it will not create that much. And the Straits of Hormuz are still operating, so it's not really impacted the oil production. So yes, the Red Sea conflict is something we need to keep an eye out on. It will be company-specific impact, but I don't think there is any serious geopolitical risk at the moment to the broader markets, especially since the market have absorbed two completely out of syllabus shocks in Russia, Ukraine and the Middle East.
A slightly more short-term view now. So we've obviously just had the Q3 earnings season go by. So Q3 FY24 is just about completed. Looking forward to Q4, as you said, we are almost halfway through Q4 already. What is your sense in terms of what we can expect in Q4 based on obviously what we've seen in Q3 and of course the month and a half that we've had of the quarter so far?
Q4 will be much of the same as far as Q3 is concerned. The key defining characteristics of Q3 is that top line growth was relatively muted, especially on the consumption side. Many consumption companies on a year-on-year basis did not report a great quarter. This was despite the festival season playing to their advantage. Even then, there was not a great deal of upside as far as growth is concerned. I think that will continue. The margin improvement. So if you start pre-Ukraine and you draw a margin of the manufacturing companies, it went like that and it's now starting to go and we are still below. But steadily, in sequential progression, you are going to see margin improvement coming through, partly from raw material. One fear that I had was that if consumption remained weak, that consumer companies especially would pass on some of those margin benefits to gain market share. That has not happened. In fact, some of the larger consumer companies are talking about being more margin conscious than growth conscious, even though the overall macro is a little adverse. So I expect, as far as the non-financials concerned, relatively muted, probably overall single-digit top-line growth, but margin improvement will drive 15% plus earnings growth, and individuals, as you go down the market cap curve, the earnings growth starts to pick up a little bit. And as far as financials are concerned, net interest margin pressures will probably abate, but there's no recovery around the corner. One thing that we have to watch out for is that liquidity remained tight. It was thought that the liquidity was more temporary factor because of government not spending, but the RBI policy seems to have clarified that that is an instrument of policy now, and that will lead to some net interest margin pressures for the financials. The other factor is that there are pockets where asset quality is weakening slightly. FY22 and FY23 was a Goldilocks year for asset quality because your incremental NPA creation was low and you were getting write-backs from past NPAs. Both of those will slow down, and therefore, we have to be careful of what we say, but it's more, to me, an upward normalization of credit costs rather than a credit cost problem. This is where it's supposed to be. It's not something to worry about from a macro perspective. From an earnings perspective, that will continue to put some pressure on overall financials earnings. But having said that, in totality, we've seen this year, after post-COVID, the pattern of India's earnings starting here and ending here through the financial year. Typically, pre-COVID, you would have a consensus earnings forecast at 20% at the beginning of the year, and you would end in single digits on a regular basis. That pattern was broken post-COVID, where the degradation of earnings through the year was not happening. The only exception, I think, was FY23, if I remember right, when because of the commodities shock, a lot of margins got surprised. That is done, and we are back to normality, where through this FY24 the pressure on earnings has not been that great, and we continue to expect strong earnings coming through.
Great. So let's dive a little bit more into you spoke of a few sectors here, but just a little bit more into specific sectors. So if you were to say put out a pecking order or sort of your preference in terms of sectoral plays, and this is obviously more on a medium to say slightly long-term basis, what would that be for the Indian markets as of now?
So we prefer, so I'm talking slightly broader sector classifications. We prefer consumer discretionary, partly because autos and auto ancillaries is included in that. We are at a point where the sectors we like are expensive, the sectors we don't like are cheap, but that's usually the case in most markets. We would prefer to go with fundamentals over valuations. We are willing to pay slightly higher valuations. So with that warning, our preference is for auto and auto ancillaries, which is part of the overall consumer discretionary bucket. We like capital goods, the capital goods infrastructure, that entire space. We are in a long-term growth cycle there, and there are many interesting ideas, mostly in the small and mid-cap space. We like real estate, even though valuations are a little stretched, but we think that real estate cycles don't fizzle out in 2 to 3 years. They last 7 to 8 years. We've just started that. There's been a lot of reorganization. So these are 3 sectors that we like. Among the sectors that we don't like are financials. That's where we are probably contrarian compared to the market. Earnings growth and return ratios for financials compared to both their own history and compared to the overall market is not at such a premium that it was. And as a result, the derating that has happened in the private sector financial space is justified, and there is no scope for re-rating. These are slow, steady compounders which will likely underperform the market from here. I don't expect too much of a downside, but they are underperforming a rising market from here. We do expect a cyclical recovery in IT late in the calendar year. But if you look at the last 5 years, you make money in the IT sector only when you get a re-rating, because the underlying earnings growth is fairly anemic. And so you have to wait for the right time to enter IT to make outperformance. Again, great companies, they will see a cyclical recovery, but the market, I think, has already discounted that.
One thing I'd like you to maybe touch upon a little bit more is the rally that we've seen in PSUs over the last year and a half or so. I mean, to the extent that the Prime Minister spoke about it in Parliament as well, right? And so what is your take in terms of both what has happened so far in PSUs? What do you expect going forward? Do you think there's a lot of froth that needs to be maybe dissipated, or do you think that the rally we've seen so far is justified and could maybe even carry on?
Well, the fundamentals do warrant a re-rating in the PSUs. One of the big achievements of the Modi government has been to clean up governance in the PSU space, and so that's one part of it. The other is, if you see the changing nature of government spending, a lot of it has gone into infrastructure, and there's a natural benefit that those companies get when the government starts spending, their order books start filling up, etc. There's been an improvement in governance, improvement in basic financial ratios, which are balance sheet. If in case of banks, NPAs have gone down. In the other cases, cash flows, return ratios have gone up. And they've been given more independence to operate. And their overall operating environment has improved in many cases because the government is spending, say, areas like defense, infrastructure, etc. It's very palpable that the direction of government spending is moving in that direction. So there is an absolutely strong case for PSUs to be re-rated. Having said that, of course, there is some froth, and one has to be a little careful in which PSUs one goes in. But I think, selectively, there is still a lot of upside left in many of the PSUs. So we would look at it sectorally. We would look at it individual stock-wise. It's that big rally where you bought any PSU and made money, that is probably over. But from here on, selectively, if you pick the good ones with reasonable valuations and strong fundamentals, I think there is a lot of upside still left.
First, I'd like to maybe ask you about the whole EV revolution that is, going to take place maybe in the next 20 to 30 years, which has just about begun. So where do you think we are at the moment with regard to that? What do you think our prospects are? And maybe even some specific companies that could benefit from the sort of EV space that, can take place in India right now?
The EV revolution is 100% here to stay. Over the next 8-10 years, EV will become a predominant part of India's car sales, vehicle sales, not just cars. The adoption will probably start in the passenger side with two-wheelers first, then cars, and buses will also happen because of the of the regulatory push. Where I think it's a really long time away is commercial vehicles. But one should not get overexcited and giddy about this. This does not mean that the ICE vehicle is dead. Adoption will be slightly slow and will take some time. I think the fires in the and the initial performance of some of the EV two-wheelers have put a lot of people off that category. It will take some time, and that is the natural evolution of any new product or technology. Like you come, go. I think two things will happen. Technology will take some time to settle down. Also, what we've seen, especially in two-wheelers, is that not so much in cars, is that the initial offerings were by companies who are absolutely new, so the trust levels were not that great. And then over time, the more trusted names will come through, and therefore EVs, if you take a next 5-year view, ICE vehicles will still play a very dominant role in the overall vehicle space. So that's one part. The best way to play it, in our view, therefore, is to have exposure to companies which are present in both, right? So both on the two-wheeler and passenger vehicle side, you have 2 or 3 companies which straddle both spaces, which have successful businesses in both EVs and two. There is some debate as to whether incumbents will succeed in EVs. I think I think they will. I think the challengers will find it difficult to establish their brands, except maybe 1 or 2. And we are already seeing that some of these challengers have a shareholding of an ICE company on top. So the way I would play it, there are 2 or 3 companies where you can exposure to both. That sort of makes your portfolio a little future proof. Because you can't go totally EV because adoption will be slow. You can't go totally ICE because the market will derate it over time. So the best way to is have a blend of both.
Right. And the second sort of idea that I'd like to talk to you about is the whole sort of brouhaha that we've seen around chips and sort of domestic capacity in chip making, with the government also trying to obviously push for this, and globally, of course, with the risks that we've seen to supply chains, where countries are obviously trying to move their supply chains as close to themselves as possible, both sort of geographically and geopolitically. Chip making has become almost like a strategic component, right? Now, with regard to all of this, do you think there is any noteworthy action happening in the chip space in India, at least maybe in the next 5 years or so, where it can become a game changer, where the country can become a game changer, or maybe even there are specific companies that could become quite important in the domestic space?
From a macro perspective, chip making will be very important, right? India is doing all the right things to ensure that chip making, so the entire Make in India story will achieve an escape velocity if we can start fabricating chips inside the country. There are a couple of plans on the anvil, and it will take some time. This is not easy. Even bigger countries have struggled to in-source chip production to their own geographies. This is a little more technology oriented than some of the mobile phone production which is being done in India are more assembly operations. Those are easier to outsource, in-source. Getting chip production is a little more challenging. Having said that, we can already see signs of success, but it takes a little longer for those to ramp up, and it's a really scale industry. Meaning, it's very difficult to be competitive unless you have large scale. But we are getting there. We will get there. So from macro perspective, it gives an economic stability. It helps your current account. It gives you a strong geopolitical lever, and so the benefits are multiple, and therefore we are all invested in the success of these ventures. Having said that, the exposure to listed companies is fairly low. So I'm not sure that it will impact India's stock markets, because if you look at number of companies that are exposed, have actually plans to manufacture chips, they're not that many. I think some of these are through existing unlisted vehicles. So I'm not too, meaning there is, I think, a bigger play in the listed space on, say, green energy, where a lot of the large listed players are investing very heavily. It will take some time, but if it does succeed, there are lots of upsides in very large companies with massive market caps. But in chips, I'm not sure that it has an impact on the listed market.
That's all for today's edition of MK Macro and Market Movers. Thank you so much for joining us. Thank you, Seshadri, for giving us the time today.
Thank you so much.
And we hope to see you again soon. Thank you so much.